Now, let's see what areas are regulated. Basically, every area. First area, formation and licensing of insurers. All states have requirement for the formation and licensing of insurers. In other words, a new insurance company needs to be licensed to do business. To get a license, the new insurance company needs to show that they meet minimum capital and surplus requirements. We know that stockholders have a residual claim on the firm's assets, which is the value left over after all other claims have been paid. In other words, stockholders got the remaining earning after all interest payments and insurance claims payments are paid. A capital is like a cushion. If this company has higher capital, it's safer for policyholders. A license can be issued to a domestic, foreign, or alien insurer. A domestic insurer is an insurer domiciled in the state. For example, a Houston Specialty Insurance Company, its domicile state is Texas. So this company can do business in Texas, and from the Texas government's point of view, this insurer is a domestic insurer. An out-of-state insurer can also do business in the state if this insurer is licensed. An out-of-state insurer means this insurer is chartered by another state. For example, a Mutual of Omaha, its domicile state is Nebraska. So in Nebraska, this insurer is a domestic insurer. Suppose now this insurance company can also do business in Texas. This insurance company is licensed. From Texas government's point of view, this insurer is a foreign insurer. Finally, an alien insurer is an insurer chartered by a foreign country. For example, Sun Life of Canada is chartered by Canada government. If this insurance get licensed and can do business in Texas, from the Texas government's point of view, this insurer, Sun Life of Canada, is an alien insurer. Let's go back to our lecture notes. A domestic insurer means the insurer is domiciled in the state. A foreign insurer is an out-of-state insurer that is chartered by another state, but is licensed to operate in the state. And an alien insurer is an insurer that is chartered by a foreign country, but is licensed to operate in the state. Let's move to the second regulated area, solvency regulation. As we mentioned earlier, if an insurance company goes bankrupt, the state government needs to step in. The state government needs to deal with a lot of things. So the state governments have some solvency regulations to make sure that these insurance companies are solvent. The first solvency regulation is related to the asset side. Do you remember this company, Executive Life Insurance Company? In this case study, we said that one reason that this company becomes insolvent is because this company invested heavily in junk bonds. And in late 1980s, junk bond markets collapsed. In other words, investing in risky assets is risky. So many state governments have laws place a limit on the proportions of assets in a specific asset category. Limits on the proportion of risky assets, such as real estate and junk bond. For example, a state government may only allow the insurance company at most put 10% of its assets in real estate. Let's move to the next regulated area, surplus. In the insurance industry, the surplus means the difference between an insurer's assets and its liability. In other general industries, we call this difference equity. Okay. But here, we call it surplus. So surplus is roughly equal to the equity. In the previous session, we know that if a new insurance company wants to do business in this state, this new insurance company needs to be licensed. They need to show that they have enough capital or a surplus. Actually, more than that, after this insurance company is licensed, this insurance company starts to do business. This insurance company always needs to meet the minimum capital and surplus requirements. In other words, this insurance company needs to hold enough capital when this insurance company does business. Next requirement is quite special. We call it risk-based capital measure, okay, RBC measure. In the previous section, we said that, well, the insurance company needs to hold enough surplus. But we know that some insurance companies take more risk and some take less. For companies that take more risks, they should hold more capital, right? For example, if this insurance company invests most of its insurance premiums in stocks, this insurance company should hold more capital. The volatility of a stock is much higher than the volatility of a bond. Stock is a risky asset. In contrast, if this insurance company puts most of its assets in treasury bonds, this insurance company can hold less capital because, well, treasury bonds are quite safe. Similarly, for the liability side, if the insurance company sells a lot of risky products, such as earthquake insurance policies, okay, this insurance company needs to hold more capital. We know that an earthquake may result in a huge loss. In contrast, if this insurance company only sells some safe products, okay, such as auto insurance policies, well, this company can hold less capital. And we know that capital or surplus is like a cushion, okay, that can absorb the unexpected loss to protect the policyholders. The risk-based capital means that the insurance company must have a certain amount of capital depending on the riskiness of this insurance company's investments and insurance operation. Every insurance company needs to meet the RBC ratio. RBC ratio is defined as capital divided by the amount of required risk-based capital. So your numerator, capital or surplus, is your actual surplus, your assets minus liabilities. And your denominator, required risk-based capital, this amount is based on the insurance company's assets risk, underwriting risk, interest rate risk, and the business risk. If this insurance company involved in many risky activities, sells a lot of risky products, this insurance company needs to hold more capital. The actual amount is decided by the government, the state government. But anyway, the actual capital this insurance company holds divided by the required capital should be equal or greater than 2. It means the insurance company should hold more capital than is required, and not just hold a little more. The ratio should be greater than 2. Let's go back to our lecture notes. RBC ratio is defined as capital or surplus divided by the amount of required risk-based capital. For each company's RBC ratio should be equal or greater than 2. Risk-based capital, RBC, is a method of measuring the minimum amount of capital appropriate for a reporting entity to support its overall business operations in consideration of its size and risk profile. So if this company takes a lot of risk, invests in a lot of risky assets, sells a lot of risky products, this insurance company should hold a higher amount of capital. If the insurance company's RBC ratio is less than 2, this insurance company will be required to take certain actions. For example, this insurance company may need to raise their capital or need to sell some risky assets or stop selling some risky products. Next, a guarantee fund. Guarantee fund is an organization established by state law. So a guarantee fund is administered by a state government. The purpose of this fund is to protect policyholders from insurers' insolvencies. So today, if this insurance company goes bankrupt, this insurance company is unable to pay the insurance amount. The state government will use the fund to pay the insurance amount. The insurance companies need to pay the related premiums to this fund, to the guarantee fund, during normal times. But be careful here, this fund only protects beneficiaries of insurance companies that are licensed to sell insurance products in that state. If you purchased an insurance policy issued by an insurance company that is not licensed in that state, the guarantee fund won't pay anything if this insurance company becomes insolvent. In addition, guarantee funds specify a maximum amount they will pay for any claim. and usually the limit is $300,000. So now suppose